We've had quite a few people come through and say that this is an important step. It's an important statement that has been made by the Indian armed forces, by the Indian establishment, and your reaction to how the markets have taken this.
Well, this is a befitting reply to whatever Pakistan has indulged in. So it's probably the most appropriate response, and maybe there would be probably even stronger measures from India as basically a response or a rebut. So I think, honestly, a great move by India and by the Indian Army, and hope that we continue to kind of give such hard-hitting responses to them. Clearly, the market too has taken this in its stride. Though this was a bit of a known unknown that yes, India would strike, India would respond. So markets have taken it in its stride, and basically the market is probably having a view that the uncertainty is behind us, the event is behind us, and now let's get back into earnings, liquidity, flows, and some of the other positive macro developments, like the free trade agreement. So I think on the whole, the market also seems to have kind of moved on from where it was.
Yes, then the question that arises is that if you have the opinion that you're going to stay invested for the long term and you want to participate in probably the best growth story anywhere in the world, how do you deploy funds considering that you've seen a considerable up move over the last 1 month, perhaps India playing catch up with certain other markets, but are you comfortable with valuations as they stand right now, or do you say that we've reached perhaps a little uncomfortable zone in a few pockets, and how would you be deploying your money?
I'd probably say that we are in a fair value kind of a zone. And clearly, India has always remained expensive on a relative basis to other emerging markets or to basically world markets as well. And that's because the Indian economy has been growing at a higher pace. Corporate earnings have been growing at a higher pace. And most important of all, the way India has been fiscally responsible, corporate India too has been fiscally responsible with a deleveraged balance sheet and a very high ROE, return on equity and return on capital employed versus rest of the world. So clearly India deserves to kind of trade at a premium valuations. I think what's going to happen going forward is that basically both India's economic growth and corporate India's earnings growth will positively surprise us. And why I say this is because clearly crude, which has been our biggest challenge, clearly has fallen and is in a structural decline. That will lead to lower inflation, lower interest rates, lower cost of capital, which I think will trigger investments and will trigger earnings growth as well. So that I think is clearly the biggest driver. The bunch of free trade agreements that India is on the verge of signing or has just signed, be it the United Kingdom or potentially with the European Union by the end of this year, or with the United States maybe over the course of next 1 or 2 quarters, all of this is going to bolster India's global trade. And these are things which essentially are extremely positive. These are all early and nascent signs of India kind of sustaining a very, very strong growth ahead. So I believe that while the markets have moved up in the last 1 or 2 months, but probably on a 6 months basis, they're still kind of flat. And we are also going to see now a whole bunch of FII flows coming in with a weaker dollar and stronger growth of India. You would also see that kind of missing link also fall in place. So on the whole, I believe that India's valuations are justified based on higher growth, responsible capital efficiency, and a very, very strong flow of liquidity from both domestic as well as global investors.